Let me just take you straight to Moody's Investor Services on inflation. One of the world's 3 leading rating agencies yesterday released that new report on African banking industry, highlighting some of the risks that rising inflation and interest rates pose to banks across the region. The report focused specifically on the banking sector of South Africa, Nigeria, and Kenya, 3 of the continent's biggest economies in which inflation is rising the most. Now, speaking to me on the latest Moody's report is a licensed dealer, investment banker, and CEO at Carry Asset Management, Johnson Chukwu. Good evening to you, sir. Thanks for coming through. Let's start from inflation today. You see the numbers in Ghana. You see the number in Nigeria. Nigeria's inflation coming very strongly at the doorstep of 20.52%. Talk to me on this. Is this in line with your expectations?
Yes, absolutely. Well, I wouldn't say I had expected it to be exactly at 20.52%, but I expected we should expect a further uptick, northward movement in inflation rate, because some of the factors that are driving inflation have not abated. I mean, you still have the issue of increasing cost of energy supply, fuel prices, diesel prices, the increasing transport costs across the country, and then the increasing cost of food items. Those factors are still persisting, and one should have expected that inflation rate will move further up northwards, which is what we saw in the month of August.
What further details do you have in the particular inflation report from Nigeria as to where do you think expectations should be moving forward? We're now technically ending the third quarter. How do you think inflation playout will be as we go into the final quarter of the year?
We're actually at the tick of the harvest season. And at this time when we are witnessing the harvest season, we are seeing food inflation at 23%. And if you look at those factors that drove food inflation, prices of bread and other cereals, prices of tuber, which includes potato, yam, and other tuber, prices of oil and fish, these are largely products that are produced locally. So if at the period when we are witnessing the harvest season, we are seeing price of these items continue to go up, then one should expect that the food inflation will further increase towards the end of the year. Again, remember that the major factor driving food inflation is because of displacement of farmers in the major farming belts. That has not been addressed. And as we move towards an election period, a lot more people will leave the farming activity and engage in sorts of electioneering activities. So you should expect a lot more farm hands will leave farming activities beyond those who have been displaced by the activities of Boko Haram, activities of herdsmen, and activities of bandits. So one should expect food inflation should possibly move further northwards. And then on the other core inflation, which is excluding food items, where you have major drivers such as gas, such as fuel, and other energy sources. I mean, when you talk of gas, domestic gases, you talk of fuel, you talk of diesel, these prices have continued to increase. 2 factors are impacting on that. 1, depreciation of local currency, and 2, the war between Russia and Ukraine that has led to an elevated price of most of the imported petroleum products. Unless that war ends, or the world economy, the global economy goes into a recession so the demand for energy supplies components decline, you should expect that crude price will remain elevated, therefore refined petroleum product will remain elevated throughout the remaining part of this year. So one should expect that at the minimum, inflation rate will remain elevated in the remaining part of this year.
So if you take the inflation to the banking report and that Moody's latest report on African banking that's highlighted, do you think rising inflation should be a serious concern to commercial banks and indeed investors?
Yes, absolutely. Rising inflation has 2 ways it impacts on commercial banks. One is increasing cost of doing business or cost of providing services. For instance, in a country like Nigeria, where the rising inflationary pressure has led to increase in cost of providing services such as cost of energy supply, most Nigerian banks are running on fuel. And if you look at the report from Moody, you realize that Nigerian banks have the highest cost to revenue ratio. And that is driven largely by other non-interest costs. That is other operating costs. So that inflationary pressure will lead to a further increase in the cost of providing services by the banks, and therefore increase their cost to revenue ratio. And that could affect their bottom line. But on the other side, you also have increasing inflation will have negative impact on the quality of their loan book. 2 things. most banks are repricing their loans, increasing interest rate, which weaken the capacity of borrowers to pay, as well as the fact that weakened purchasing power occasioned by inflation will also further weaken the demand for goods and services, which weaken the revenue of credit customers. So from the perspective of increased costs, and then for perspective of increasing non-performing loans, what you call the cost of credit, the banks could possibly suffer from both angles. Of course, we also know the banks have the benefit of repricing their risk assets and getting a wider net interest margin because they are not repricing their deposit liabilities at the rate at which they are repricing their risk assets.
So as you look at the Moody's report across three of the main jurisdictions in Africa, South Africa, where the report says that the banks will have a bit of an issue because of the level of union of what you call the labor issues in South Africa. Nigeria doesn't have that much in the banking sector, as it were, but Nigerian banks are more exposed to corporates, as the South African banks are exposed to individuals' credit. So talk to me about this. Do you think Nigerian banks have a bit of concern here about the exposure to corporates vis-a-vis household consumer credit?
Yeah, two things. Nigerian banks are more exposed to corporate because we really don't have consumer credit in the country. So the challenge you have with exposure to corporate that you don't easily reprice risk exposure to corporate because the corporates have strong bargaining powers. There is competition among the banks within the Nigerian banking space. So you really can't compel major corporates to pay you exorbitant rates. Again, Nigerian banks have already imposed or already charging high interest rates on their loans. Unlike in South Africa, where a lot of the loans are to consumer credit customers, and many of such loans are to mortgage borrowers that are indexed to some interest rates, benchmark rates. So those rates are easily repriced by the banks. On the converse, the South African banks, like you pointed out, have a very high unionized labor force, and those labor unions will certainly agitate for higher remuneration for their members as inflation continues to move northwards. So the South African bank will suffer from higher cost of labor, which will affect their bottom line. For the Nigerian banks, the top line is where they will not get so much benefit. The South African banks will get benefit of the top line because they can easily reprice their loan books. But Nigerian banks are already having high interest rates on their loans and can't further materially increase those loans, particularly because their loan exposure are largely to corporate that have bargaining powers.
So how do you think let's finish off on the inflation again and interest rate. How do you think the central bank will decide in 2 weeks' time when they meet for the month of September's MPC meeting?
Interestingly, the central bank have a difficult situation. We saw economy recover and grow at 3.54% in the second quarter of this year, but that is not strong enough because some of the key sectors of the economy are seeing slowdown in their growth. The central bank will have to be wary of further increasing interest rates that will eventually tip the current economic growth. Again, we've also seen that the 250 basis point increment that the central bank has effected on the monetary policy rate in the last couple of months have not had any material impact on moderating inflationary pressure. So the inflation we are witnessing today is not coming from money supply, it's rather coming from structural inefficiency in the system or in the economy, such as the issue of heightened food prices occasioned by displacement of farmers from the major farming belts. It cannot be addressed with monetary tools. The issue of high cost of fuel, high cost of gas, and other energy sources is not going to be addressed by increasing the monetary policy rate. So the central bank must be cautious in applying the brakes on available liquidity so that it does not tip further the economy into the negative growth.
We thank you so much for your time and do have a great evening. We appreciate this analysis. Johnson Chukwu, investment banker, licensed lead dealer and CEO at Carry Asset Management. Thank you so much.